Now here, another example of showing divergence on top to see that D2 reversal. Here, RSI made a high about 5 in the morning. Price action continued higher, even though the RSI did not, into the New York session into 10, 11 o'clock in the morning. So with that price action rising and RSI falling, you know that the market conditions can change. So with the push up, the move being up, knowing that it can change, that means it's either going to chop or fall away. Here, it falls right back to where it came from. Shoots up with that huge push and comes right back down based on that divergence on top. So it's important, again, to not ignore it. You would want to take note of this on top and draw it with these lines as I have, using reaction point 1 on your RSI high, reaction point 2 is your price action high, and you would want to use this to say, okay, it's there. If I'm long, I'm going to look to take profit now. Or if I'm looking to go long later in the day, I'm going to wait because there's divergence on top and I wouldn't want to trade long into a falling RSI. Or the third option of what this tells you is that you could use it as a D2 and take it short. Now, again, a lot of these examples I'm saying it's a D1, it's a D2. We're going to go over exactly where the entry signal is with the D1 and D2 in the next chapter. But for now, I want to keep driving home the point that you should use reaction point 1 and reaction point 2 as your RSI high or low and your price action high or low to draw that divergence. That's what we're going over here. Again, RSI high set about 5 in the morning, but price, as you can see, continues higher. It ends up actually creating a falling RSI into the next day as price continues up. What does that rising price action but falling TDI tell us? It tells us that it can change. Here, the change comes as it consolidates and then falls away. It actually fell lower than where it started its original move up from. So using the divergence on top, we're going to be able to spot D2 reversal entries right here and take this down if you choose to. Another example, NZDJPY. RSI is set at its high, price action goes higher twice, 3 jabs, and it ends up falling back down to the low of day. That change, that fall, that drop, would be qualified as change after the move up to start the day in the Asian session. So it moves up, creates the divergence. That means change is coming. It's either going to chop or move lower, and it ends up coming lower. Now, why did this end up coming up higher into the next day and into the overnight? Well, that's where you would turn to the higher time frames to see that it's in an overall uptrend. So this divergence here on the 15-minute is signaling the short-term pullback back to the 200 EMA before the move in direction of overall trend on the higher time frames. Again, another example on top, RSI sets its high and price continues higher into the next day. That divergence with rising price and falling RSI tells you what? You've heard me say it now 15 times. It tells you change is coming. It's either going to chop from that point or fall away, and it ends up falling away as a D2 idea. Here, another example on NZDJPY. RSI sets its high at the changeover of day, and price chops its way slowly until it finally makes a new high here later in the day around 8 o'clock in the morning. Look at how that RSI is falling. That tells you the direction this thing is going to move. Even with the TDI in the buy zone, what it should signal to you is that change is coming. You would not want to try to go long here after that divergence is set because you know that it could chop and or fall. And that's exactly what this does. It falls, looks like it gets chopped around news and then continues even lower into the 12 o'clock hour. So it's important, so important, to use divergence on top in an overall uptrend like this, even with that perfect TDI, to say, hey, I'm not going to look to go long in here because I know the divergence can signal change. And if you can get in the habit of doing that, then you're going to get into an even easier habit of taking D2 reversal entries. Here, when you see the potential top set in, you're going to be able to measure risk reward and take these in the opposite direction of trend, EMA to EMA. And we're going to go over that in chapter 4. Here's another example on EuroCAD. Look at the RSI setting its low, price action then coming a little bit lower, but the RSI is rising. With that rising RSI and falling price action, that signals to us, drumroll, change is coming. The change here took this higher instead of just chopping it sideways. Even with a perfect L50 in the sell zone, even with EMAs coming into a downtrend, once this divergence is set, I would never look to go short here during the rest of the day because I know it could use that divergence and be reversing. It could be changing direction completely. Here's another example. This is GBP CHF. You can see the RSI on top sets its high. Price action jabs higher one more time. And that's where we see that divergence that tells us the RSI tells us that it's falling. Even if price action moves higher and continued higher, we would want to make sure we do not ignore the fact that the RSI was making lower highs as price action made higher highs. Now, when you see all these examples that I'm showing you in this chapter, you're saying, Austin, this looks like a lot of reversal stuff. It's a lot of reversal stuff. In these examples, it is. But if you can identify divergence correctly, you're going to use this same tactics, the same skills that you're using to find reaction point 1, like you do here, and reaction point 2 here on the top. You're going to use that same skill set to identify it on the lower time frames in the direction of trend, on the 1 minute, on the 5 minute, to get those solid D1 entries. So don't look at this as, oh, all these examples, he's showing me divergence on the top, divergence on the bottom. That's not the point. The point here is to show you divergence itself is using 2 reaction points at least to show the falling or rising RSI in opposite direction of what price action is doing. So here again, falling RSI, rising price action, that signals divergence. Here, rising RSI, falling price action, this can lead to the D2 reversal idea. And at the same time, it can say, hey, be careful trying to go short after this divergence is already set. And when it pulled back to the 21 EMA right here, you could look and say, maybe we should short this. Look at the L50, look at the EMAs. I would say, no, you have to draw the divergence like this. Do not ignore from the previous day the RSI low, especially when you see the when you see it continue to kind of chop its way lower without making RSI come down and without making that RSI come and make new lows. So it's really important to never, even if you're not going to trade it, if you're just doing your analysis, you should never ignore divergence, whether it's helping you or it's against you. This is another example of a potential reversal. NZD-JPY, you see the RSI set its high, price action comes a little higher, that creates divergence. That can signal change. What's the change? It reverses its entire day's worth of rise and drops to a new low of day. So here, it's rising, it's rising, it's rising. You would look in here off the 50 EMA for divergence on the lower time frames to trade long. Now here on the 15-minute, when the divergence sets in on top, that tells you that long move from earlier could change. That long move was based on the L50 rising and the EMAs being in a buy zone. But now you have divergence on top that tells you it could change, and it does. It comes lower. So now that we've gone through all of these markups showing you how to draw divergence using reaction point 1 and reaction point 2, you should understand what divergence is, where you should be looking for it, what's it telling us, and how to draw it. So you're probably itching to figure out, how do I turn this into an entry signal, Austin? I want the D1, I want the D2, right? Are you ready for this? So let's break it down a little bit more before we jump into chapter 3. The differences, again, are in trend, D1, counter trend, D2. Write this down, screenshot this, you don't want to forget it. In trend is D1 entries, counter trend is D2. So what's the difference? The in trend trades are going to be off significant levels, whether it's 50 EMA, 200 EMA, yesterday's high, Asia high, something like that. It's going to be off a significant level, and the higher time frames are going to agree with the direction. So you're going to have multiple reasons to take that trade. Now, this is going to be something where you use the L50 and the EMAs to help you dictate the direction of trend. So if you can find a perfect L50 in the buy zone with perfect EMAs that match it, telling you to go long, you're going to use all the significant levels that you know how. Yesterday's high, yesterday's low, or you're going to use the 50 EMA or the 200 EMA. You're going to use those significant levels that I gave you in the earlier parts of this course to look for longs in direction of the overall trend off that significant level. And if you can have higher time frames agree with you, you're going to have a really solid D1 trade that possibly can run for multiple days. Flip this and look at the counter trend. This is going to present at the extremes, the overbought, the oversold, the maxed out ADR, yesterday's high, yesterday's low, and you're looking for it to go full reset, we call it, back to the 800 EMA. So you're trading back in the direction of the EMAs when you're talking about the D2 entry. These should also use the higher time frames to confirm or deny the direction you're trading for that reversal. So for example, if you're looking at a downtrend and you think it might be at a bottom because it's oversold, you would want to go to the higher time frames, the 1 hour, the 4 hour, the daily, and see, hey, are these long biased? Would it make sense for me to buy it off this support level? Because if so, then that D2 reversal idea could make sense because the higher time frames are always going to overpower it. But if they don't, you can then use the higher time frames to pull yourself back and say, I'm going to remember what Austin said, that D2 trades are tougher than D1 trades, they're less probable, and I want to turn my focus somewhere else. So now you should understand very clearly the difference between the D1 and the D2. It's D1 in trend, D2 counter trend. If you have any questions about this chapter, about how to draw divergence, if you have any questions about what it's telling us, what it means, and where to look for it, please drop a comment below or reach out to me via email or Facebook or Telegram, whatever you can do to get a hold of me. I'm very happy to clear that up for you if you have any questions at all. Going forward, I'm not going to backtrack so much on all the basics we just covered, on drawing the divergence, reaction point 1, reaction point 2. I'm not going to touch on that. I'm going to go fast because we need to go through a lot of markups. We have 130 slides in the next chapter of the D1 system alone to go through. So if you're ready, I'm ready. Let's get into the D1.